Ladies and gentlemen, thank you for joining us today and welcome to our firm's Investing in India program and the fourth webinar in the series. My name is Samir Shah and I'm a partner in Khaitan's corporate practice group. I would like to extend a very warm welcome to every one of you wherever you are around the world. Investing in India is a webinar program we have curated especially for existing and prospective foreign investors. This will help them and their advisors gather an enhanced understanding of some of the key issues affecting them in doing business in India. The program will cover over a period of time all issues of interest to our target audience. In today's session, we will be examining the different business aspects of India's direct taxes regime, and in particular, bearing in mind items relevant for foreign investors looking at India. We hope to provide valuable insights to effectively support your Indian investment decisions. On this slide is the program for today's webinar. If you do have questions, please submit them using the facility provided in the webinar portal. If we do not cover questions during the webinar, we will of course respond offline over email after the webinar. We will also be circulating a copy of the presentation, the summary notes, and the recording of this webinar in due course. Next slide, please. Let me now introduce our speakers for today. All registered participants should have already received an email with their resumes. Therefore, I will keep the introductions very brief. Our presenters are Ms. Ritu Shaktawat and Mr. Rahul Jain, who are direct taxation partners in our firm. They each bring extensive experience in advising foreign clients on their investments in India and also on navigating the Indian tax regime. So with that, I would now like to invite Ritu and Rahul to make their presentation. Over to you, Ritu.
Thank you, Samir. So in today's presentation, we will be covering these key areas. We'll start with what are the key focus areas that a non-resident investor should be aware of when investing in India or earning any income from India. We'll also give you an overview of direct tax regime, again from the perspective of a foreign investor. We'll also discuss about tax treaty benefits, what are the conditions, how non-residents can benefit from tax treaty provisions and benefits therein. We'll also discuss what are the tax considerations or tax costs at the time of a potential exit event from Indian investments. Anti-abuse regime, another topic of importance, relevance, given the way the jurisdictions are moving towards substance-based taxation, and we will discuss what are the tests under domestic law and under bilateral tax treaties. We'll cover tax disputes framework and also discuss what are the mechanisms to get tax certainty under Indian tax laws. We will, at the end of the session, also tell you a bit more about what we see as the next big thing happening under Indian tax laws. And then we'll close the session with key takeaways and we'll take questions. With that, let me come to the key focus areas. Next slide, please. Thank you. So in terms of key focus areas for a foreign investor, you should understand that the jurisdiction from where you invest in India or the jurisdiction where you're located, where you're earning any income from India, that could have a bearing on effective tax costs payable in India. The legal form of the Indian entity in which you invest, that will also have a bearing on overall tax costs of holding India investments or at the time of potential exit from Indian investments. So here, please do refer to our last webinar in the same series where we had discussed tax and legal considerations relevant to different forms of legal entities in India. Funding instrument, where you, let's say, invest in an equity instrument of an Indian company versus a debt instrument versus a hybrid or a convertible instrument, all these instruments could have varying tax consequences. And it's important to evaluate them before deciding the investment instrument. Tax valuation, another important area because Indian tax laws have specific tax valuation requirements which apply at the time of investment, divestment, and non-compliance could lead to adverse tax consequences for the parties to the transaction. Repatriation strategies, another important area, because the preferred repatriation strategy should be evaluated from a tax perspective, because there are various modes available to, let's say, extract excess cash in an Indian company, and each of those modes could have different tax consequences. Exit modes, what mode is selected at the time of exit, whether it's a secondary transfer of shares of an Indian company, whether it's an indirect transfer of shares of an Indian company, or the exit is achieved by way of, let's say, a buyback of shares or cancellation of shares. Each of those modes could have varying tax consequences in India. Transfer pricing, another important area for non-residents to be aware of. Indian law has comprehensive transfer pricing regime and documentation requirements. These essentially apply to cross-border related party transactions, and in certain cases to transactions between unrelated parties as well. Last but not the least, tax compliances India. If you're earning any income from India, there could be certain tax filing obligations for which one needs to get a tax ID, and therefore there could be some lead time. So one should prepare for it in advance. There is some paperwork that needs to be organized so that the transactions go on smoothly. Income repatriation is not stuck just because these tax IDs are not in place. With that, let's discuss a quick overview of direct tax regime in India for foreign investors. So foreign company is a non-resident for Indian tax purposes. What that means is that a foreign company earning any income sourced from India, and there are certain deeming rules as well, that income is taxable in India. Non-Indian income is not subject to Indian taxes. But there are certain circumstances under which a foreign company can be deemed as an Indian tax resident. And please note that Indian tax residents are taxable in India on their global income wherever earned. So therefore, implications could be far reaching. The criteria there is place of effective management. A foreign company having a place of effective management in India could be deemed as an Indian tax resident. Structures which are generally exposed to this risk are, let's say, India outbound structures, where an MNC group is headquartered in India, key decision makers are sitting in India, or even in structures where, let's say, there's a US holding company having an India subsidiary, and there is a common CEO, a common CFO, or a common KMP acting for both the companies. So in circumstances where, let's say, these individuals are visiting India for the business matters of the Indian company, and during that India presence, if they are also taking decisions for the US company, those are the circumstances, again, in which this risk could become relevant and should be evaluated. Coming to scope of taxation, like I mentioned, foreign companies or non-residents are taxable in India only on income earned from India, not income earned outside India. And there are certain deeming rules as well. Therefore, any transaction having an India nexus, directly or indirectly, should be reviewed from the perspective of India tax implications. Tax rates, the general corporate tax rate for a foreign company is 35%. And there are two additional levies which apply to this base tax rate. Those are called surcharge and education cess. The rate of surcharge varies depending on the category of the taxpayer, whether it's a company and then Indian company, foreign company, or whether it's a non-corporate taxpayer. And it also depends on the level of income. For a foreign company, the highest rate of surcharge is 5%. So 5% of 35% is the surcharge. Then there is education cess, which is standard across all taxpayers, and the rate is 4%. Tax increased by surcharge is then subject to 4% education cess. So a 35% base tax rate, which when you add surcharge and education cess becomes 38% on an effective basis. There are special rates which are applicable to income such as royalty, interest, dividend, service fee, etc. And all these incomes are not subject to the high corporate tax rate of 38%. The corporate tax rate of 38% applies when a foreign company has a taxable presence or a permanent establishment in India, not in any other case. Tax treaty benefits, very important for non-residents to understand and explore when earning any income from India. India has a wide tax treaty network with over 95 countries around the world, and Indian law recognizes that if a tax treaty is more beneficial, it prevails over domestic law provisions. And we will discuss it during the course of the presentation what these benefits are. Withholding taxes, non-residents need to understand that Indian law has strict withholding regime with respect to payments to non-residents. So therefore, if you are earning any income from India, please note that the person paying will withhold the applicable tax upfront and then remit the balance. Therefore, the tax evaluation or assessment needs to happen upfront, and then the person paying has to ensure that the tax that the non-resident is required to pay in India is withheld at source and deposited with the Indian government. And generally, if the person paying does not comply or there is a shortfall in withholding taxes, then the payer is exposed to tax risk in India, where Indian government can recover the taxes which the person receiving was supposed to pay from the payer. And therefore, payers would generally be more conservative rather than aggressive if there are, let's say, certain gray areas or if there are different positions involved. So again, very important aspect to discuss upfront at the time of transactions or earning any income from India. Lastly, like I said, tax valuation requirements. In the context of share deals, for example, when you're buying shares of an Indian company or selling shares of an Indian company, tax laws prescribe certain minimum pricing requirements. And if the transaction takes place at a discount to such value, then the discount is deemed as taxable income for the buyer as well as the seller. And tax laws prescribe methodologies for different classes of assets. With that, let's look at tax treaty benefits and how one can benefit from those beneficial provisions or concessions under tax treaties. So here we have selected a couple of tax treaties which are generally commonly seen in the Indian context. There are far more, but for the sake of comparison, we have shortlisted these jurisdictions. And we are also depicting the tax rates under domestic law of India. So let's take an example of dividend and buyback proceeds. When an Indian company distributes dividends or proceeds at the time of buyback of shares, that income is taxable under Indian law at 20% for a non-resident investor. If we take an example of India-US tax treaty, the tax rate could reduce to 15%. Under Mauritius treaty, the tax rate could reduce to 5%. So therefore, there are reasonable savings when you compare domestic law rates versus tax treaty rates. Let's look at another income stream, fee for services. Under domestic law, the income is taxable at 20%, but again, under India-US, the income will be taxable either at 15% or nil. And the tax rate of 15% versus nil depends on the nature of services. If services are of a nature which make available or impart technical knowledge, skill, expertise, know-how to the service recipient, then those are generally the taxable category of services. Any other services which do not make available knowledge, skill, etc. to the service recipient, those are not taxable under the US treaty. By way of quick examples, engineering services, training services, designing services, those are the services where generally a service provider will impart knowledge to the service recipient such that service recipient is able to apply that knowledge going forward. So these services are taxable services under India-US tax treaty. Other services like consulting services, advisory services, those generally do not impart knowledge and therefore should not be taxable under the India-US tax treaty. So again, a significant benefit compared to Indian law tax rate. So India-Singapore also has a similar benefit. Mauritius treaty, for example, doesn't make a distinction depending on nature of income. So any service fee that a Mauritian resident earns from India, that will be taxable at 10%, which is again half the rate of what's applicable under domestic law of India. Coming to business income, another important area of focus, like I was mentioning, for a foreign company, the tax rate, the corporate tax rate is 35% plus surcharge and cess, which results in an effective rate of 38%. It applies when the foreign entity has a taxable presence or a permanent establishment in India. To explain it by way of an example, if we extend the same services arrangement where a US company is providing services to an Indian company, let's say it is not providing services only from US, it sends its team of employees to India to provide certain services on ground. In such case, the Indian presence of employees of the foreign company would be deemed as a taxable presence of the US company in India. And in those circumstances, the income attributable to the India presence or the India operations of the US company will be taxable at the corporate tax rate of 35%, not at special rates, which we have discussed in the previous row. And therefore, one needs to also undertake an attribution analysis to see how much income the US company earns in this example is actually attributable to the work carried out in India. So out of the entire service arrangement where some functions are carried out outside India, but some functions are carried out in India, one needs to carry out an attribution analysis. Generally, tax treaties prescribe the principles which need to be applied for the purposes of attribution, but there's no objective criteria there. And generally, one needs to apply transfer pricing based principles when one looks to attribute income to the taxable presence or permanent establishment in India. Having discussed these benefits, let's now look at what are the conditions for availing tax treaty benefits. Now, tax treaty benefits are not automatic. There are certain conditions. And like we have seen, the tax savings under the treaties would be reasonable. Key conditions are a mix of certain objective tests or criteria, and some are generally more subjective in determination because they're largely based on facts of each case. So in terms of mandatory conditions, the non-resident claiming tax treaty benefit must have a valid tax residency certificate issued by the government of its home jurisdiction. Non-resident also has to file an online form. There is a prescribed form that needs to be filed where certain details are missing in the tax residency certificate. It's a simple self-declaration form, just that it needs to be filed online. Next comes the other tests, where we have also seen a lot of litigation in the context of tax treaty benefits and eligibility, where tax authorities in India would do a detailed factual review before successfully granting treaty benefits to non-residents. Legal and beneficial ownership is one of them. Now, keeping aside the debate on in what cases a beneficial ownership or to what income streams one should test beneficial ownership, tax authorities do look at beneficial ownership as an important criteria regardless of the nature of income. Who is a beneficial owner? It's not defined under law. Generally, beneficial owner is a person who is free to use the income that it earns, and it's not under an obligation to pass on that income to any other person. It's not earning that income as a nominee or an agent for somebody else. Commercial substance in the structure is very important to ensure, given the way the laws are changing and evolving and including substance-based conditions. And we will discuss this in the subsequent slides as to what are the substance criteria under domestic law and under tax treaties. But very important for structures to have commercial substance. There are certain grandfathering provisions for investments made prior to 2017, but now any structures which are being set up now or income that is being generated from India now, those are subject to anti-abuse rules. Lastly, liability to tax in the home jurisdiction. Now, this is a bit of a technical concept, but just to explain it simply, liability to tax means that the entity earning an income from India and claiming treaty benefits should be a taxable entity in its home jurisdiction. It shouldn't be a non-taxable entity. So it's largely a local law determination that whether the entity claiming treaty benefits is actually a taxable person or not. And in the context of tax exempt entities, this becomes an important determination. Now, certain treaties like India, US, India, UK, they do recognize treaty eligibility of tax transparent entities such as partnership firms, estates, and trusts, but many other treaties do not. And therefore, this becomes a subject matter of analysis as to whether a tax transparent entity such as a US LLC is eligible to tax treaty benefits, which is commonly seen when we look at India, US structures. With that, let's now, having discussed the taxability of various income streams, let's now look at taxability at the time of eventual exit from Indian investments. So gains that a foreign investor or a non-resident earns At the time of exit from Indian investments, shares or securities, the tax rate varies between 12.5% and 35%, depending on whether the gains are short term in nature or long term in nature. In case of listed shares, the holding period threshold is 12 months. Therefore, if the listed shares are held for more than 12 months, the gains are long term and therefore subject to a 12.5% tax rate. Again, this is the base tax rate. Once you add surcharge and cess to it, the effective tax rate will come to about 13.65% for a foreign company. If the shares are held for less than 12 months, then the gains are treated as ordinary income, which for a foreign company means a 35% or an effective 38% tax rate. In case of unlisted shares, the holding period threshold is 24 months. If the shares are held for more than 24 months, the gains are taxable at 12.5%, otherwise as ordinary income at 35% for a foreign company. Interestingly, for unlisted debt securities, as per a recent amendment, regardless of the period of holding, the gains are treated as ordinary income, taxable at 35% for a foreign company. But the tax treaties could be beneficial, and let's now look at the tax treaty incentives with respect to capital gain income. So, in case of shares of an Indian company, India-US tax treaty, for example, where a US company is selling shares of an Indian company, there is no exemption. Gains are taxable as per Indian law. In case of Singapore, Mauritius, the exemption is available where the investment in Indian company is made prior to 1st April 2017. For investments made after 1st April 2017, there is no exemption under the India, Mauritius, and India Singapore tax treaties. Netherlands is an interesting example. As per the Netherlands treaty, if the stake in the Indian company is at least 10% and the sale is to a non-resident of India, then the treaty provides an exemption from Indian taxes. If the sale is to a resident of India, there is no exemption. And if the stake in the Indian company is less than 10%, then regardless of the tax residency of the buyer, whether it's an Indian person or a non-Indian person, the gains are exempt under the India-Netherlands tax treaty. Coming to debt securities, again, India-US, there is no benefit, but in various other treaties like the ones here, Singapore, Mauritius, Netherlands, there is an exemption under the tax treaty, and therefore the tax benefit can be significant when you compare taxability under domestic law of India versus applicable tax treaties. Now, this was when you directly exit from India investments. Now, let's look at a scenario where there is no direct transfer of India assets, but an indirect transfer of Indian assets. So here, the illustration is a US company holding shares in a Cayman Co. A Cayman company then in turns holds shares in a Singapore company, and Singapore company holds shares in the Indian company. And let's say the transaction involves transfer of shares of Cayman company by US company to a buyer wherever located in India, outside India. Now, such a transaction on the face of it should not be subject to Indian taxes because the asset in question is shares of a foreign company, not an Indian company. But under Indian law, as per certain source rules, shares of a Cayman Co. can be deemed as Indian assets if it derives substantial value from India. Substantial value is defined as Cayman Co. deriving at least 50% of its value from Indian assets held directly or indirectly, and the value of Indian assets exceeds 100 million Indian rupees, which is roughly 1.15 million US dollars. And therefore, one needs to carry out valuations to see how much value the Cayman Co derives from the Indian company, and there are prescribed valuation methodologies here depending on different scenarios. Now, this provision has a bit of an interesting history, and without going into too much detail because the developments here happened 10, 12 years ago, but just to refresh for those of you who may be aware of it already, this provision was introduced after the infamous Vodafone tax controversy, where Vodafone had bought Indian telecom business from Hutchison way back in 2007 pursuant to a similar indirect acquisition. The Indian government went after Vodafone, treating it as a defaulter for not having withheld Hutch's taxes on the transaction because Indian tax authorities treated that transaction as taxable in India. The Supreme Court of India decided in favor of Vodafone, saying such a transaction is not taxable in India because the law doesn't provide for it. In response to that, government amended the law in 2012, saying such an indirect transfer of Indian assets is taxable in India. So now this provision is very much part of India tax code, and it's relevant in all the global deals where Indian companies or Indian investments are held directly or indirectly by the relevant offshore target. And therefore valuations become relevant, and it is a risk not just for the seller but also for the buyer, because buyer has a strict withholding tax obligation under Indian law. And Vodafone is the case in point, because government went after Vodafone as the first point of tax recovery, not against the seller, which was Hutch, to recover taxes on the transaction. If the transaction is taxable in India, then buyer, seller, as well as the underlying Indian entity has certain filing obligations, and the disclosures that the Indian company has to file are extensive with respect to the overall transaction structure, because the intention of the government is to get information about these transactions through the underlying Indian companies. There are certain exemptions. Small shareholders who own less than 5% stake, voting interest, and have no management or control rights, they are excluded from this provision and therefore would not be subject to this tax, even if substantial value test is satisfied. And there could also be exemptions under applicable tax treaties. So again, coming to the same set of tax treaties, India, US, there is no exemption, but various other treaties have exemptions for such a indirect transfer tax in India. India, Singapore, Mauritius, Netherlands, all these treaties are beneficial. With that, I hand over to my colleague Rahul to discuss other topics of relevance and importance. I hope you enjoyed the presentation so far. Thank you for listening. Rahul, over to you.
Thank you, Ritu. And I think that was a wonderful summary of what the key tax considerations are when it comes to investment into India. And I do hope that our audience has got a very great insight into it. Having understood the tax considerations, let's talk about what are the gray areas when it comes to investment into India. And the first topic that comes to my mind is, are there any anti-avoidance rules in place? World over, if you see, the countries have kind of reached a consensus that we need to protect our tax base when it comes to cross-border structures. And on the same lines, therefore, India has introduced general anti-avoidance rules in the year 2017. The general anti-avoidance rules, called as CAR, treat a transaction as an impermissible avoidance arrangement if there are certain tests which are satisfied. Now, there are two tests, so to say. One is a main purpose test, and second is a tainted element test, as we call it in our day-to-day affairs. When it comes to the main purpose test, what one needs to satisfy, or what the tax authority needs to demonstrate, that the main purpose of a particular transaction or a structure was to claim a tax benefit. Now, that itself is not important. There are certain other therefore conditions to be satisfied, that that structure should either lack a commercial substance, or should not be bona fide in nature, or should create exceptional rights and obligations, or result into abuse of the tax provisions. Only once a transaction satisfies both this test, the provisions of general anti-avoidance rules kicks in. And once it kicks in, the tax authorities have the power to look through these structures and compute the taxes based on substance over form. If I were to just give a few examples in what scenarios a provision of GAR could apply. For example, like Ritu was explaining in the previous slide, in an indirect transfer scenario, when you are looking at a shareholder who is a US resident, there is no tax treaty benefit under India US. And however, if let's say a US entity sets up an intermediary SPV in Mauritius or Netherlands, that particular SPV may claim an exemption. And therefore, the question of why did you set up an SPV in Mauritius or Netherlands? Does it have substance in it? Was there a commercial rationale attached to it? Now, this is a provision under the Indian tax law. Therefore, what about the provisions under the tax treaty? If you look at it, like we discussed, globally the countries are couching for it, and OECD, in their plan of base erosion and action plan, they introduced a provision called as multilateral instrument. All the countries who have signed up for multilateral instrument are now mandatorily required to include a principal purpose test provision under the tax treaty. Now, what it means is by the plain reading, principal purpose test seeks to deny the tax treaty benefit if any of the principal purpose was to claim such benefit. The only exception is if granting of such treaty benefit is in accordance with the object and purpose of the relevant provision. Now, what does that mean? Are there any objective thresholds to determine it? There is none so far, neither under the provisions of GAR under Indian tax law, nor under the principal purpose test. Therefore, the question demands, on the face of it, if you look at it, the provisions of GAR and principal purpose test may appear similar. But like we discussed, GAR provisions have two tests: main purpose of the entire transaction or a step in that transaction, plus a tainted element test. Whereas principal purpose test looks at if any of the principal purpose. Now, therefore, if you look at it, the principal purpose test is more broader in nature in that sense. And therefore, the tax authorities may want to look at a particular structure, see what were the dominant purpose of setting up a structure. Did you come in, for example, in this US entity coming in India through a Mauritius structure? Was there a commercial rationale? Does it hold any other investments? Was it a fund set up for global investments, or was it just an intermediary SPV set up for India investments? Where is the control and management located? Is it in the home jurisdiction of the entity claiming the tax treaty benefit, or is it located in the parent jurisdiction? What form of funding was used? Was it equity or debt, and why it was used? Because, like we were discussing in the previous slide, dividend could be taxed at a different rate, under the treaty interest could be taxed at a different rate. And you could always structure your affairs in a manner to optimize the taxes in India as well as the jurisdiction outside India. And therefore, when you look at any particular structuring of investment into India, I think one very needs to be very mindful of this anti-avoidance regime and ensure that it passes the muster of GAR as well as principal purpose test. I would say if you meet the muster under the principal purpose test, you'll by default meet it under GAR because principal purpose test is more broader. What are other anti-avoidance regime? In fact, even before the GAR and PPT came in, there were certain tax treaties which had specific limitation of benefit clauses. For example, if let's say a Mauritius entity is investing into India, earning some income, there were certain conditions that only if they have incurred certain operational expenditure in Mauritius, they'll be eligible to. Similarly, for example, in Singapore, they had certain limitation of benefit conditions that only if let's say the income is remitted to Singapore, then the treaty benefit will be allowed. Now, therefore, those limitation of benefits still continue to apply, and therefore, it becomes more so important when you're looking at a structure of investment into India. Do take care of all of this. And at the end of the day, it's subjective. And when I talk about it being subjective in India, it is going to result into a litigation at some point in time, given the aggressive stand of the Indian tax authorities generally. And that brings us to our next section on tax dispute resolution framework in India. As you would generally know, India is known to be an aggressive jurisdiction when it comes to tax litigation. And the reasons are multiple, of course. One is the subjective interpretation of the tax provisions, the ever evolving businesses, and the whole process under the Indian tax law. When it comes to filing of tax returns, claiming your positions, one would expect that okay, if you file a tax return in an appropriate manner, the matter should get over there. But the tax officers have the wide power. They look at your tax position, they look at all the information, they call for the explanation. They even have the power to call for the information from the authorities of your home jurisdiction and verify and reconcile it. Now, once they do that and they've completed their exercise, they are expected to pass an assessment order. And if they accept it, well and good. We are good, of course. There is no claim. But if let's say they reject it, then the litigation starts at that level. And there is a very good hierarchical process in India that you have various opportunities to file appeal. Against the order of the tax officer, the appeal goes to the Commissioner of Income Tax Appeal or a dispute resolution panel, which is more in the case of a transfer pricing on international tax cases. Depending on what the outcome of your appeal or an application before the dispute resolution panel or the commissioner is, if it is in your favor, nothing like it. If it is against, you can go for an appeal before the income tax appellate tribunal. Mind you, any adverse order passed by the Commissioner of Appeals or Dispute Resolution Panel could be filed. The tax department also could file an appeal before the tribunal. Now, tribunal is a fact-finding authority, and this is an authority which has been most sought after for in India. The reason is tribunal is known to take a very balanced approach when it comes to the tax litigation in India. They look at all the facts, they ensure that all the positions are covered, they hear out the arguments in a very reasonable manner and pass the orders accordingly. And most of the relief therefore is expected at the tribunal level. And also it being a final fact-finding authority, because the appellate authorities after the tribunal will only look at a question of law and not a question of fact. Let's say the tribunal passes an order in your favor, again fine, but any further appeal then goes to the High Court and then eventually up to the Supreme Court. Now, is there any timeline of completion at the tax officer level? Yes, the tax officer is required to initiate the proceedings in a time-bound manner. The maximum period a tax officer has is a period of 6 years, where they can initiate the proceedings, and thereafter they have to complete the assessment or the audit in a time-bound manner. But when it comes to the appellate mechanism, there is only recommendatory time limit and there is no definite time limit. Now, therefore, depending on the backlog of the cases and the annual targets and the various other parameters, the litigation could go on for quite some time. Right? And we've seen cases being dragged on for over decades also. So therefore, it becomes very important to understand, and I'll connect it to my previous points and what Ritu was explaining. When you look at structuring of investment into India, the anti-avoidance regime and the positions, one needs to be very clear in terms of the tax positions to ensure that you're not caught up in the whole litigation process in India. Let's talk about some case studies, right, to just give you an overview of how the tax litigation in India looks like and what are some of the recent trends when it comes to tax litigation. The first case study in the next slide, please. The first case study that we're going to discuss today is the case of Tiger Global. And if people tracking India tax updates may be aware of it, Tiger Global acquired shares of Flipkart Singapore. They sold it to Walmart. And the transaction was taxable in India due to the indirect transfer provisions like Ritu was explaining earlier. But Tiger Global claimed an exemption under the India-Mauritius Tax Treaty. To get certainty, they filed an application before the tax authorities to get a nil withholding tax certificate. Knowing tax authorities, they denied the application, saying that you have been controlled from USA and not Mauritius. Tiger Global went into they filed an application before the authority for advanced ruling, and they also denied it, saying that while you have two Mauritius resident, one director is a US resident, and he seems to be the calling the shots. And there is also a US resident who is controlling your bank account, who has a signatory right to the bank account. Looking at these two factors, the tax authorities and the authority for advanced ruling said you can't be treated as being controlled and managed from Mauritius. You have been controlled from US. You are being set up in Mauritius to claim the benefit and therefore denied it. Tiger Global went into appeal before the Delhi High Court, and Delhi High Court took a very reasonable view. They looked at all the factors together. That the Tiger Global was an entity which is a tax resident of Mauritius, have been holding this investment for quite some time. All the decisions are being taken by its board of directors. Just because one director is a US resident doesn't mean that you will treat it as being controlled from US. And the second one also was that the fact that the bank account signatory was a US resident, that was also a power delegated or authorized rather by the board. And therefore the board took the AR, the Delhi High Court took a positive view of this matter and said that okay, you are eligible to claim the statutory benefit. And after that, the department went into appeal before the Supreme Court, and the Supreme Court surprisingly has stayed the order of the Delhi High Court. And therefore, it resulted into a situation where there is no certainty for Tiger Global at least today. But if you look at it on an overall basis, even for the positions prior to the Delhi High Court, there were various factors which one could consider for claiming the tax treaty benefit. Yeah. The next one we are going to discuss today, the next case study, is on principal purpose test. And that case study is basically, if you look at it, it's in the context of a Luxembourg-based entity where it was set up by a Cayman entity. The Luxembourg Fund was set up to raise funds from global investors and invest into jurisdictions in India as well as outside India. Here again, they earn certain income from India, and the tax authorities challenged it, saying that this was set up by a Cayman entity primarily to claim the treaty benefit, and therefore principal purpose test is not satisfied. Taxpayer went into appeal. The tribunal noted various factors, and which are depicted in our next slide. That see, this is an entity which is a tax resident of Luxembourg. Can we move to the next slide, please? This is an entity which is being set up in Luxembourg. It's a tax resident of Luxembourg. It has been filing tax return, paying taxes in Luxembourg. Its global investments constitute 60% to 86% of your overall investments, and they've incurred substantial expenditure, operational expenditure in Luxembourg. Therefore, this is not a case where you can invoke principal purpose test and say that this was set up primarily to claim the treaty benefit, and therefore tribunal granted a treaty benefit here as well. Very important to note, this is a very first of its kind ruling in India, and therefore very helpful when it comes to determining your structures on how do you basically delineate and how you basically decode what factors you should look at to understand that okay, whether it passes the provisions of the of car and principal purpose test or not. Having discussed the case studies and the framework of the tax litigation, how does an investor get certainty over his tax position in India? What are those? Are there any alternatives under the Indian tax law? And that is what we are going to discuss in our next slide. There are, of course, in the Indian tax law, certain alternative remedies which are available to get certainty over the tax disputes in India. And in our next slide, the first one that we are going to discuss today is a nil withholding certificate from the tax authorities. Can you move to the next slide, please? Yeah. The first one is when you're saying that, like we were discussing earlier, as a peer, I can always approach the tax authorities, or even the recipient can approach the tax authorities to procure a nil withholding or a lower withholding tax certificate. The tax officer will look at the factors and then grant the certificate as appropriate. This is, of course, not a final determination, but it does provide certainty to the buyer when it comes to their withholding tax obligation. Because if you do not withhold applicable taxes, the taxes of sellers could be recovered from you, or the taxes of the income earner, the recipient could be recovered from the payer along with any interest and penalties. And therefore, this is a mechanism which is worth considering for depending on the facts and circumstances. The next one that we are discussing today is a safe harbor provision. Safe harbor provision is more relevant in the context of transfer pricing for certain Indian companies engaged in providing software development services or IT, ITS services, knowledge processing services, the BPOs, and so on and so forth. Here, what has happened is because the services are more or less streamlined in that sense, and to provide certainty, the Indian tax law said that we'll give you an option, opt for the safe harbor margins, which are prescribed under the Indian tax law. For example, a 17 to 18% margin for software development services. If you opt for it, the tax authorities are not going to challenge it, and therefore your transfer pricing margins are accepted. There are no disputes to that effect. Because if you look at from transfer pricing standpoint, once the comparables are challenged or once the method are challenged, it could result into a lot of complications. Extending this further, the next one is an advanced pricing agreement. This is also relevant in the context of transfer pricing, but it's more comprehensive, not specific to any sector. As a taxpayer, you can enter into an agreement with the Indian government, Indian tax department, to either determine your arm's length margin or the manner in which margin should be determined. And once the advanced pricing agreement is executed, it is applicable for the next 5 years. You also have a provision to cover it until previous 4 years. So therefore, you're looking at an over a bit of 9 years being settled by virtue of entering into an advanced pricing agreement. Now, also important to note that this could be a time-consuming process, given that it looks at various factors for over a period of 5 to 9 years you're looking at. And given the number of applications, the APA program has been quite successful in India. Over more than 600 APAs being executed till date. Therefore, this is something which is worth considering for the structures where we are looking at a very long-term strategy in place in India. Next one is the Board of Advanced Ruling, and this is what was previously called as an authority for advanced ruling, set up in India initially for non-residents to give them certainty before they could even enter into transactions with Indian residents and gain certainty over their tax positions. Later on, the law was extended for Indian residents as well, and this became a body where most of the non-residents used to file their application and get certainty over it. Of late, it has become a bit inactive in terms of the applications and the proceedings. But of course, this continues to remain a mechanism under the Indian tax law. One can certainly evaluate and assess if this is something to be worth looking for. The next topic that we are discussing is a mutual agreement procedure. And the mutual agreement procedure is again a mechanism under the tax treaties between India and jurisdictions. This is a more nuanced and a more I would say higher level mechanism where the authorities of two countries would come together look at the issues, let's say be it on account of whether a permanent establishment is triggered in India, or how do you attribute income to India, whether a service is taxable in India or not, depending on all the facts and circumstances. And this is where a certainty is to be provided so that both the countries are aligned, the taxpayers' interests are aligned, and therefore it gives a final certainty over it. So far, there is no more litigation on it. If you look at all these factors, while of course there is no one solution that fits all the circumstances, but you could always look out for this. I would always say an well cleaned up advice is always an alternative to all this mechanism, and therefore to avoid the litigation. And I think going by the, and there are various other remedies which are being set up now. For example, India, and that this is what we are going to discuss in our next slide. India has recently introduced a new income tax bill, and the new income tax bill has been introduced on 13th February 2025. This bill seeks to do away with the current existing income tax law, which is existing from over last 6 decades. And you can imagine the last 6 decades law being getting revamped and amended again and again, how complicated it has become for anyone to decode, decipher, interpret, and apply the positions. Therefore, the objective of this bill is to simplify the provisions of the law, make it more structured, stabilize as much as possible, and make it easier for taxpayers as well as advisors and tax departments to interpret. And going by this very objective, when we look at the fine print of the bill and we still continue to go through that bill, it's a bill running into hundreds of pages. But of course, the idea is not to increase the taxes. The idea is to simplify it, and that is what is coming out of the fine print of the bill as well. It does clean up a lot of issues. It does provide a lot of clarification. At the same time, of course, there are certain drafting issues which are there, and which I think based on the market insight, it does look like it will get ironed out over a period of year. This bill is now before the standing committee. They are looking at it independently. It's a group of ministers looking at it independently, and then they will send it out for public consultation. And therefore, we are being actively looking at it and discussing it with internal as well as external stakeholders. The bill is supposed to be effective from 1st April 2026, and therefore the next 1 year is going to be full of excitement when we look at decoding the new income tax bill, making suggestions, looking at the amendments coming in and the updates and so on and so forth. I think the next year, I wouldn't even say the next 1 year. I mean, once the new law comes in, you are in for next. Uh, Given that we are still managing the new income tax law and decoding it, I would say the next 5 years at least is something which we should be looking for when you look at, okay, how do you interpret this bill. I think with this we come to the end of our session, and I hope this session did give you some useful insights, be it in terms of what are the key tax considerations and what are the pros and cons, what were the pitfalls, what are the gray areas you need to be mindful of, and what is the next that you look out for. I think with this, I'll hand it over to Samir. Samir, please feel free to take it up.
Thank you very much, Ritu and Rahul. We'll let you both take a break for a quick 30 seconds while I rummage through the questions. I can tell you the chat box has been buzzing with the number of questions we've received. So, and I am conscious of time. I don't think we'll be able to take all of them, but I will try and bundle a few together. And why don't we do this? Why don't we give Rahul a quick break? Ritu, why don't we start with you? You spoke a little bit about beneficial ownership, and we know there are different parameters of measuring ultimate beneficial ownership, significant beneficial ownership just from a tax perspective. Are there any specific disclosures that are required in tax filings in India?
Sure. Thanks, Samir. So that's a question that we get asked often, especially by groups or foreign investors or funds who may be sensitive about how much information they need to disclose to, let's say, India tax regulators. And let's accept all of us at some level are wary of what disclosures are going to the tax office, how they interpret those disclosures, will they come knocking with more tax questions and would be subject to long drawn proceedings, etc. So, very valid question for a foreign investor to ask and understand what could be the potential disclosures and if there are possible workarounds from a structuring standpoint. So, when a foreign company earns income from India, it has to file a tax return in India. There are certain exceptions, very limited situations, but generally one should assume that there will be India filing obligations. In the tax return, there are specific disclosures with respect to parent company And if there are intermediary entities, then the immediate parent and ultimate parent entity. There's also a disclosure requirement with respect to shareholders owning at least 10% beneficial ownership in the shares in the company. And there's one more disclosure requirement with respect to ultimate beneficial owners of at least 10% stake who are natural persons. This last one is not a mandatory requirement as of yet. It is an optional disclosure. So one could proceed with tax filings without having to disclose the ultimate beneficial owners who are natural persons. In terms of certain other disclosures, one also has to disclose the managing directors, secretaries, principal officers. And therefore, we have seen sometimes clients deciding to invest through an SPV instead of their main entity, so that at least the management related disclosures are limited to the management at the SPV level, not at the ultimate parent or the main entity level. That's how I'll summarize the disclosure requirements, but one should keep tracking it because these disclosures are in the annual tax return forms, which are notified every year. So if there are any changes, one should track them on a regular basis.
Understood. Ritu, we'll come back to you. There are some questions on compliance burden under Indian tax filings. But Rahul, if I just switch to you, and we're obviously looking at investing in India, so which include new investments as well as existing investors. Are there any specific tax incentives, whether regional or sectoral, that you can talk to our listeners about?
Sure, sure. Samit, generally, India is moving to an incentive-free regime now, and this is also because this is offset by reducing the corporate tax rates for Indian companies and the concessional tax rates in the capital gains tax available anyway. And with that objective, India has done away with the special economic zone related incentives which were available previously. There is, of course, a new regime which is called a gift city regime and which is being designated as a financial investment destination or something which is akin to Singapore or Luxembourg, you would say. While of course there are certain incentives in terms of for entities set up in gift city, for example, an entity set up in the gift city can claim tax holiday on its business income for a period of 10 years and can also enjoy concessional rate when it comes to minimum alternate tax or an alternate minimum tax. Also, for the funds which are set up in gift city, there are quite a few exemptions. For example, if you're looking at investing in listed space into India, there is only a tax to be paid by the fund on the shares of an Indian company. If you are doing on debt securities, there is no tax to be paid, and there are no taxes to be paid by the investors as well. Other than that, I think there are certain incentives, Samit, for sovereign funds, pension funds, for investment in infrastructure sectors. And the government has recently extended the date by which they could invest and claim the benefit until 31st March 2030. So I would say to summarize, while domestically the incentives are being phased out, for the foreign residents, there does remain some element of incentive for example, if you come to gift, if you're looking at infrastructure investment, and I think then that's how I would like to address that question.
I think I'll use that as a segue into my next question, and particularly infrastructure, the point that you mentioned. We have multiple questions around uh, the use of subsidiaries and SPVs in India, and particularly in infrastructure, we know it's very common to have project-wise SPVs. So let's say on a more broader perspective, if you are a foreign investor planning your India presence, you will obviously look at business and legal, etc. But from a tax perspective, does it make sense for you to invest directly in multiple companies, or should you, let's say, set up a more mothership kind of an Indian subsidiary and then use that to invest in different vehicles?
Sure. Samir, I think that thank you for that. It's a very interesting question, and it does become, I would say, it's a full-blown advice that one will need to look at when looking at this type of a structure, that whether you should invest directly or whether you should come in through a subsidiary. I'll keep it very simple. If you're looking at an investment into India directly, the income streams you're looking at is dividend income or interest income or capital gain, and therefore you are liable to tax directly on those income at the tax rates under Indian law, or the applicable tax treaty, whichever is beneficial to the investor. When it comes to investment through a subsidiary in India, And it again demands a question whether the subsidiary is being set up in the form of a private limited company or a limited liability company or a limited liability partnership. Because in a limited liability company, the income is taxed at the company level and any subsequent distributions are also taxable for the investor. Whereas in a limited liability partnership model, there is only taxes to be paid at the level of the partnership and no taxes are to be paid by the investor when it comes to distribution of profit. So let's say if you're looking at a limited liability company structure, I would say it's always better to invest directly in that sense, unless the parameters are different, that we are not looking at an exit scenario, but only a dividend upstreaming, because there is no there's a pass through available, so there is no double taxation to that effect when it comes to distributions of dividend by an intermediary India company to the final shareholder. And when it comes to an LLP structure, again, the taxes rates are higher and therefore different considerations, so to say. But plain vanilla direct investment is generally the better.
Understood. So maybe what we'll do is, I'm just conscious of time, we'll probably do one question each. Uh, and Ritu, I said I've reserved something for you on compliances. There seems to be this overarching thought process that yes, there is some lack of certainty, but there's also a very heavy compliance burden. What's your take on that? Are Indian tax authorities looking to increase the compliance burden or ease it, or what's the mix?
Thanks, Amir. So this has been one of the industry demands every year when the budget is around the corner, to ease compliance burden, especially for foreign investors who may be doing a one-off transaction, earning income, let's say once a year, then nothing for next 5 years. Then what are these non-residents supposed to do? So non-residents have to mandatorily get a tax ID in India, which is called as permanent account number, when they are earning income from India. Once you have registered for it, you can't surrender it as such. There is no process or mechanism prescribed. And once you hold a PAN, the permanent account number, one should be prepared that there may be tax notices issued in the ordinary course, where the government will want to understand why you are not filing tax returns, but you're holding a tax ID in India. So yes, there are these practical issues. Everything is electronic. Notices are sent on an automated basis. But coming to the question of government's thinking on compliance burden, one, when we look at it from a regulator standpoint, yes, they would want to get as much data as possible. They wouldn't want to lose out on information collection because that's important for tax collection, tax compliance. But if we see, let's take an example of the budget recently 1st Feb 2025, where government has eased compliance burden with respect to tax collection at source provisions, where even a non-resident, for example, had to register, do tax collection on certain transactions. So they are taking steps to ease it wherever possible, and it doesn't harm the interest of the revenue and doesn't harm the interest of the taxpayer. But everywhere else, I think government is clear that they want data, and tax ID is one of that, because everything gets linked to the tax ID number and government has access to that data at a click of a button. And even regulators are exchanging information on a real-time basis. So yes, I think tax return, tax IDs, that's gonna stay. Some correction here and there one can expect to ease compliance burden and filing obligations.
Understood. And Rahul, very quickly, just in terms of stock incentives for employees of, let's say, Indian subsidiaries of foreign companies, quick snapshot, what are the kind of tax compliances or tax implications they're looking at?
Sure, Samir, and that's again another point that we keep on discussing with our clients based in US jurisdictions, outside India, everywhere. This is more relevant in the context of when you're looking at giving incentives to the employees of Indian subsidiary, and the stock options are being given under a global policy. For example, a US company issuing stock options to the employees of the Indian entity. At the time of grant per se, there is no taxable event in India. The tax, the taxable event in India arises at the time of exercise of the options. Therefore, when the options are exercised and the employee receives the shares, the fair value of such shares which are received, as reduced by any amount which is recovered from the employee, is taxable as salary or as perquisite in India. And therefore, as an employer in India, I need to ensure when I'm processing the payroll, this income is factored in and the applicable taxes are with it. At times, we do see that their cash payouts may not be sufficient to meet the withholding taxes. And in those cases, you can always ask the employees to first pay off the cash demands and then, do the compliances. So in a way, it's been quite straightforward when it comes to stock incentives. I mean, there are of course various other uh, options I think available, whether it be in the form of a restricted stock unit or a phantom stock unit and all. But I think the principle remains the same. So far, it's an incentive to the employee. It's taxed as a perquisite in the hands of the employee, and therefore the employer has an obligation to withhold the applicable taxes. I hope that addresses the question.
Fantastic. I think that should, and I'm sorry, ladies and gentlemen, there are far too many questions for us to be able to take. Tax is always a very, very interesting subject. People tend to have a lot of questions, but unfortunately, we'll have to conclude today's webinar. We've taken a lot of your time. So if we flip to the next slide, we've listed out some takeaways from today's very informative discussion. And I think really the first and the foremost point has to be that India is demonstrably moving towards a more business friendly tax environment. They will not be able to otherwise attract and or retain investment. Uh, for non-residents, there is a vast network of tax treaties which they can leverage. There are concessional tax rates and tax protections. We've noted that India's anti-avoidance measures, Rahul mentioned and Ritu mentioned, are now at par with global standards. So they ensure a level playing field. But at the same time, there is a strong and clear emphasis on greater tax compliance. And a very crucial step in minimizing the risk of tax litigation is the fact that there is a critical importance of proactive evaluation and a thorough risk assessment. So, in order to avoid a long drawn tax litigation, investors must understand the nuances of the Indian tax system and engage in careful planning to navigate potential challenges. Therefore, one cannot underscore the importance of staying ahead of the curve through diligent compliance and expert advice in order to have a successful enjoyment of investment returns from India. With that, I would like to thank our presenters today for sharing their expertise and experience. I thought they did a simply outstanding job. It's a very dry subject, but for them to hold our attention in the manner that they did. Thank you very much, Ritu. Thank you very much, Rahul. And to you, our audience, thank you very much for being an attentive audience. We will, of course, send you a copy of today's presentation, all of the summary notes, and a link to the webinar recording. We will also circulate a request for your feedback. We typically run a poll, but we haven't done so. Please do send us your feedback. It won't take more than a minute. The form has purposely been kept short. Thank you for your attendance once again today, and we look forward to being of assistance and interacting with you in future Investing in India programs. Thank you very much.
Thank you, everyone.